Welcome back, everyone, to Find My Way Home Live, where we get together here mostly every Thursday. Sometimes Scott gets busy and he's touring the world and doesn't have time for us. But most weeks we're here. We have some of our guests from the Find My Way Home Expert Network. Today we've got Benson Pang, who is like myself here in California, and we got Paul Carson, who is on the other side of the country in Philadelphia, Pennsylvania, and Scott is in the bottom middle of the country in Austin. So today we are going to be talking about adjustable rate mortgages. As rates have risen throughout this year, it's a topic that comes up. They're greatly misunderstood. Probably the biggest thing I get from people is, oh, aren't those terrible? Shouldn't we avoid them? So we're going to go into exactly what they are, who should consider them, who should not, why they're not evil, when to use them, and how to use them. So with that, why don't we just jump into what is an adjustable rate mortgage? It's fairly straightforward. Unlike a fixed rate mortgage that has a 10, 15, 20, 30-year repayment period with a fixed interest rate, you have an adjustable rate that's going to vary based on a schedule, an index, and a margin. So you're probably asking, what are those things? Paul, why don't you walk us through? If I'm interested, I'm a borrower, and I go, hey, I would like an adjustable rate. What is this index thing that I'm talking about? How do you explain that to a client who's considering an adjustable rate mortgage?
Well, I thought I knew ARMS pretty well now, but now with the change in index, it's a pretty big topic change. So the index is what the adjustable rate mortgage is tied to. In years past, that has been what's called LIBOR, but they're phasing out LIBOR, and now it's shifting over to, I believe it's SOFR, correct?
Yep. Yep. So what that is, and what's important about this is, it's an adjustable rate mortgage, but it doesn't mean the lender just gets to make up whatever number they want. Your
Correct.
loan documents are going to spell out exactly how this works. So the index is one portion of that, and that SOFR index is basically, it's a published rate of the cost of funds. And with certain types of loans, Scott, you were talking about home equity lines of credit. A home equity line of credit is also a variable mortgage, and that's tied to prime rate. So the important part is, it's a published number that you and the lender are agreeing to adjust that rate on that schedule, and they're going to look up the number, the index. They're going to see on the adjustment date, what is the index, and we're going to add a number to it. Benson, you want to walk us through what the margin is and how that generally works? Benson, we lost you. We
Oh,
lost your
there you
mic. You muted us. You didn't want to talk with us.
and oh, I'm right here. So, what margin is basically it is a percentage that's being added to the index and create a rate that you're basically making payment on, and this margin, a lot of people think of it as a risk of borrowing money, and it can adjust according to your personal situation. So let's say if you're doing 10% down versus 50% down, that margin can change vastly. Just like if you have a low credit score and a high credit score, that margin can also change.
So yeah, there's a number of factors that can go into that, but let's just look in simple terms. So those aren't the only indexes. We had talked about those probably being the two most common right now. Are you guys seeing anything other than SOFR for your first mortgages and prime for your second mortgages? Any other indexes that you guys are seeing offered from lenders?
It's not often I see anything except the normal stuff. Yeah, as LIBOR's been phased out, but yep.
Actually,
So
I've been seeing the COFI index that's
the
replacing.
old 11th district cost of funds, that was so what, we'll get to option arms in a minute, but that was one of the most common indexes for adjustable rate mortgages back in the day, for option arms. So let's take a look at what this looks like. Now we have a fully indexed rate. What that means is, we have your index, so let's just go with the SOFR index for now, plus the margin, and that says on the adjustment date, those two numbers combined is going to give you your fully indexed rate, and that is what you adjust to. So just using an example here, we have a lender that offers a 2.75 margin on a SOFR index loan, which as of today is at 1.09. So the fully indexed rate would be 3.84%. So the funny part is on a 7/6 ARM, so that's fixed for 7 years, that rate today is probably in the 4.25 range. But if you were to adjust today, that fully indexed rate, you would adjust down. So it's funny. That's most of the stuff that I'm seeing with SOFR. That's what it looks like. So now that you kind of understand how your interest rate looks like, I probably should have thrown another banner up here. That's the fully indexed rate, but kind of what I just threw out there was the start rate. So there is a start rate for your loan that will be on the note. So we just mentioned in a 7/6 ARM, you're probably in, I shouldn't say probably because these vary, like Benson said, with credit scores, lender, type of loan program, loan size. This program I'm looking at is only for jumbo loans, very well qualified borrowers with jumbo loans, and they're at about 4.25 right now. So that's the note rate. So for the fixed period, for the 7 years, you're going to pay that. At the end of the 7 years, that 7-year fixed 7/6 means it's going to adjust every 6 months. So that's your adjustment period. So if we were hitting 7 years, the 84th payment today, on the 85th, we would be going to 3.84 on that. So that's your note rate, what you pay on. That's the fully indexed rate, what it adjusts to. Why don't we talk about one of the really important things with adjustable rate mortgages is the qualifying rate. The qualifying rate, you may ask, well, what do you mean? My note rate is what I'm paying on. Shouldn't I also be qualifying off of that? Why don't you guys walk us through this? Paul, what happens if we have a fixed period of 60 months or less in terms of qualifying? And this isn't consistent from every type of loan, but it's pretty common to go through it the way that Paul's going to talk about.
Yeah, most oftentimes when you're looking to get let's say a 5-year fixed or a 5/1 ARM or a 3/1 ARM, I guess nowadays we're calling them 5/6 and 3/6, which is bizarre. I have to get it completely changes the lingo.
Doesn't flow off the tongue nearly as easily.
It really doesn't. But with a 5/6 or a 5 or a 3-year ARM, you have to qualify off the existing note rate plus the margin. Plus a 2% margin on top of that, versus if you took a 7-year ARM, that whatever that note rate is on the 7-year ARM, that is what you qualify based on the note rate itself. But if anything 5 years or less, you have to qualify on a margin of an additional 2% on the note rate, just to make sure you can handle that payment shock when it will adjust.
And that last thing that you said is, go ahead, Scott.
Yeah, real quick, I wanted to interject because you guys are really, you're unpacking and you're dissecting ARMs. I really want to simplify this for consumers that might be watching this that have no idea what we're talking about. Adjustable rate mortgages don't constantly adjust. We typically call them hybrid because they're fixed for a period of time. And that's what you're hearing these guys say 3, 5, 7, and 10. And then the second line is how often they adjust once the fixed period is up. Is that accurate?
Absolutely. So, and it's really only going to be a 1 or a 6. 1, as Paul was saying, means it adjusts annually, and that 6 is going to adjust every 6 months. And for whatever reason, like Paul said, 10 years ago, the 1-year adjustment was common, and now the majority of them are adjusting every 6 months. Probably just a little more advantageous to the lender to get to bump it to market. But I guess only advantageous when it's going up. If the market comes down, it's advantageous to the borrower, right?
Yeah. And I would also say that most people are taking ARMs because they know something is going to happen within the next period of time that maybe they're okay taking the risk of it adjusting. Most people don't take an ARM assuming that they're going to ride it through the adjustment period.
Scott, hold on for a second.
Not
before
always.
We start going, let's just close out how they work before we get into why would anyone want, why would I want an adjustable rate? I want a fixed rate. I don't, this is crazy. Okay. These guys are talking crazy stuff over here. So kind of just to close out the thought, we talked about how they work, how they adjust that qualifying rate. What's the logic? If I'm a borrower, I'm sitting at home going, qualifying rate, adding 2%. Why in the world would you do that? So Benson, with a 3-year or 5-year or something fixed for 60 months or less, why? What's the logic of making me qualify at a higher interest rate?
So as a lender, we want to make sure that if the rate starts changing on you as the borrower, we want to make sure you still qualify, you still have the ability to repay the loan. So giving you a lower rate at 3-year fix or 5-year fix, that's going to come real soon, right? So we want to make sure that, hey, if we stress test this, make sure if we add that 2%, you're still going to qualify for that payment.
Yep, and that's exactly what it was. Back in the day, before the housing crisis of 2007, 2008, they would give you a 3-year ARM or a 2-year ARM, which comes really fast, even faster than a 3-year, and qualify you at the start rate. And those were known as a teaser rate, start rate, and they caused problems. So post financial crisis, the Consumer Financial Protection Bureau, the FHFA, came back and said, if you're going to have a loan fixed for 60 months or less, you have to have an additional qualifying number that makes sure if the rate goes even higher than what is expected, that borrower will qualify and be okay. So with that, kind of transitioning the conversation to where Scott was going, one of the things when you bring up adjustable rates that we hear often is, wait, that's crazy. Why would you say the word adjustable rate mortgage? Didn't adjustable rate mortgages cause the financial crisis? Didn't it cause the housing bust of the mid 2000s? So when someone says that to you guys, Benson, Paul, how do you respond?
Bad adjustable rate mortgages combined with many other factors caused the housing crisis. So
what makes a bad adjustable rate mortgage? We're talking about them, but what were some of the elements of the loans that were available 15 years ago that were bad that we don't have now?
My start in this business was early 2008 as everything was unwinding. Subprime had basically closed up shop. Things were falling apart. And so I never really saw these products firsthand go through this. I only heard about the kind of the nightmare stories after the fact. A lot of these subprime loans were very low FICOs, very questionable credit decisions, and were really not even qualified at all, with light documentation, very low, if any. These types of loans shouldn't have been made in the first place. And that was the fundamental part of that. We could, I've read so much on this topic. I could go on for hours.
Here's the fun part. I started doing this stuff in 1995. And those loans existed, the 228 and 327, they were available, but they weren't common. And they got super common by 2005, 2006. And that was the problem. So that teaser rate, there's actually two things primarily that made those bad loans. If you're taking a loan that's only fixed for 2 years or 3 years, basically you need appreciation unless it's a refinance and you're a low loan to value. You're going to have to refinance that loan. So when we talked about the index and the margin, the index was what it was, but these subprime loans that were only fixed for 2 or 3 years had really big margins. So you would have a start rate that was little and a fully indexed rate that was huge. So it's a time bomb. You don't have the option of just going, well, now I have a variable rate that's going to adjust every 6 months or a year. It's going to like double or triple your payment. So they were sold saying, market's hot. You're going to have more equity in 2 years. We'll just refinance it. And people would just do this over and over and over again. Equity gets stripped and it's musical chairs. When home values stopped going up, all of those people were unable to refinance. So we don't really have ARMs available for borrowers who are less well qualified. There's some non-QM stuff, but the loans adjustable rates are given to better qualified borrowers. If it's fixed for less than 60 months, they're qualified at a much higher rate than the start rate, and they have to show their ability to repay. The other type of really bad adjustable rate mortgage that is no longer with us is the option ARM. So it was different, and it was sold to generally a higher credit score borrower, but that didn't require you to even make an interest-only payment. So it was adjustable, but the bad part of it was you could make a payment that didn't even pay the interest. So your loan was growing every month. So you can start seeing those two types of loans were a big element. Did they cause the housing crisis? No, they did not. Were they a part of causing it, and did they make it much worse? They absolutely did. So the loans that we're talking about today, very different. They're fixed for a longer period of time. They have smaller margins. You're having to make sure that you actually qualify at not just a fully indexed, but fully indexed plus if it's fixed for a shorter time frame. So those are important things. Now, Scott, let's get back to where you wanted to go with this. Consumer says, great, now I know how adjustable rates work. Why? Why would you take an adjustable rate versus a fixed rate mortgage? Benson, have you done many recently? Have you had a client take an adjustable rate, and what are they looking at? What benefit are they getting from adjustable versus a fixed?
Yeah, definitely. In fact, we actually have been doing a lot of ARM loans, and I was talking to a sales manager at a new build at a builder office, and we're talking about interest rate hike and how a lot of clients stop qualifying because they're sticking with a 30-year fix, right? And I'm like, why don't you turn them into ARM loans? Have them take an adjustable rate mortgage and see if they qualify. So I think the strategy going forward is, let's say if you are a borrower, you're trying to buy a new build, and 6 months ago you could have qualified, but now you don't because the rates have gone up. So I think it is definitely a great option to look into a ARM loan to see if you can still qualify so you can continue to buy this house.
So if you're looking at the longer time frame, so a 7 or a 10, and you can qualify at that start rate, and the start rate is lower, then obviously it's going to help the debt to income ratio there. Which are all loans being offered with adjustable rates, or is it specific loans targeted to specific borrowers who can benefit from this?
Yeah, so typically we're talking about jumbo loans, right? Conventional loan, conforming, meaning if your loan balance is not that high, you're regular buyer. I think the 30-year fix is probably going to be a better option. And then other type of borrowers that are getting an ARM loan is, we're talking about bank statement loan, these non-QM alternative document loans. And they're usually going on the ARM loans. So bank statement, DSCR investor loans, those are usually the ARM loan candidates.
And Paul, are you seeing the same thing for your Fannie Mae, Freddie Mac loans that are going to a borrower buying at your conforming loan limits? Are they able to benefit from these adjustables?
We're starting to have a lot more conversations with folks who are just want to see, is it even worthwhile to take a look, and what's the interest rate spread? So if a 30-year fixed is, let's say it was, not to quote rates, but usually it's like going from a 30-year fixed to a 10-1 to a 7 and a 5. You start going down in eighth to a quarter sometimes between the products. So if you can save, depending on it's ARMs, from what we're seeing, it's like they make more sense on larger loans because you can save more each eighth of a rate, because that's how it works. So usually we'll see it with more seasoned homeowners who've owned a home before, have plenty of reserves, good with managing cash flow, things like that. We rarely see somebody who is a first-time home buyer who wants an adjustable rate mortgage. That's very rare, if at all. But oftentimes clients know, hey, I should be able to save a decent amount on interest rate and get that down from a 30-year fix to something that's, if you can save 1/4 to 0.5%, maybe even more depending on the product or the situation, it starts to add up and it makes sense, especially, okay, I have 5 years, I have 7 years to plan for what's next. And it's planning out, if the market improves within that time frame, being ready to take advantage of an opportunity and refinancing, or knowing I'm definitely going to be moving in that time period, and I know I'm not going to have that loan that long. So just thinking through managing the risk as best you can, but also at the same time too, it's a good bet on yourself to use these loans, save interest, and save money.
So everyone has an opinion on interest rates, and anyone that knows me knows that I have an opinion on interest rates. They what's the full saying, Scott? You're the philosopher. The arc of history bends towards justice. What's the whole saying? Yeah, I digress. You guys know what I talk about, what I'm talking about. The arc of interest rates for the last 40 years has gone towards lower. So now magically, post COVID, post Russia invading Ukraine, many people with opinions think that rates are going to go higher. This crazy, weird 40-year period that we had with ultra low interest rates, or decreasing all the way down to ultra low interest rates, is gone and is behind us. Probably a topic for another episode. I don't believe that's true. We've seen Japan going on since the late 80s, early 90s, going on 30 plus years here of ultra low interest rates. And for many of the same reasons, we're likely to look at the same. But what we do have undeniably is right now, today, rates are much higher than they were 6 months ago, or any time really in the last 11, 12 years. So this is a way to get in at a lower payment, maybe qualify for more home with home prices up higher. And if and when interest rates do normalize, even if they don't go back down to the 2.75 or 3% where we were 6 months ago, if you're looking at a 5.25 rate, a 4% interest rate on a 30-year fix sounds awesome. So if in the interim you can get a 7.6 ARM, a 10.6 ARM at 4.75, and then refinance 2-3 years down the line to a 4%, it's a good strategy, a good interim move. And then with that, people always ask, cool, what if rates don't go down? So Benson, what do you tell your clients if they take a 7.6 or a 10.6 and they go, well, what do I do if rates don't go down and rates are higher 7 to 10 years from now?
Well, first of all, I think we haven't touched on the cap of these ARM loans, right? So we're talking about how amazing it is. It's a little bit lower than current 30-year fix, but when it starts adjusting, it doesn't just go straight to the current rate or future rate. So let's say a future rate goes up by 5% or even higher, 6%, whatever it is. There are caps in place that is placed by these lenders. And usually, let's say you typically hear something like 2.25, right? 2.25 means that your first year change in the interest rate is not going to go up more than 2% of your current note rate. And then the other two, the middle one, is every year after is not going to go up another 2%. And then there's also a cap of 5%, which is the last number. So your rate is going to be capped out at 5% in the entire lifetime of the loan. So going back to the question is, rates, if it goes up, there's a cap. And also during the next 7 years or 5 years, whatever your rate is fixed at, you're already saving money for that period of time, 5-7 years. So if you have to start paying a little bit more, you think about it as, well, my break-even point is really not at 7 years if it's a 7-year fixed loan, right? It's not really at 7 years. It could be at 9 years or 10 years or 11 years. And I don't know. I look back 10 years ago, what I was doing and what have I achieved in the last 10 years. It's a lot of things that I've done. And
You've covered a little ground in the last 10 years.
So much has changed, right? People move, people change jobs, and we are unique individually, but we're not all that unique, right? Because things happen to us. Scott moved, right? So everyone moves in the next 10 years. It's just,
or you have kids, or you have whatever, right?
So what you guys are talking about is important. So especially for a first-time buyer, First-time buyers generally move sooner than a move-up buyer, and tenure in the home has been stretching out. I think we're about 11 years right now is how long the average homeowner lives in their home. And when I started back in the 90s, which was like 150 years ago, that number was about 6.5, 7 years that people would move, and they would probably refinance, or typically would refinance at one time in that time frame. So when you look at that, the refinances over the last 40 years have been pretty standard at about every 3.5 to 5 years. The market has given people an opportunity to refinance. But what has stretched out is the average tenure in the home. So people are staying there longer. Now, again, less common for a first-time buyer to stay in a home for a long time, but most Americans, on average, 10, 11 years in that home. So again, let's go back and say, the world changes and rates never go back down. You never get a chance to refinance. We've been there for 10 years. You didn't move. You and your dog are watching TV in the same living room. Besides those caps, what other elements or things are working in a borrower's favor that 10 years from now, it's not likely to be problematic for them to have a higher adjustment? You got any thoughts on that, Paul?
Yeah, probably a good example is my wife has had an adjustable rate mortgage that she got in 2006. So it was a 5/1 ARM, as it was fixed for the first 5 years through 2011, and it has been adjusting every year since 2011. That first adjustment in 2011, the interest rate went from 5.875 down to 3.875. It dropped 2 full percent. I think, if I recall correctly, we saved about $725 a month on principal and interest. At the time, we then had to move out of that condo, rent it out. We were buying a house in the suburbs. It was great timing. So it actually continued to go down, went up and down for a number of years. It most recently, after the index dropped, LIBOR basically plunged after COVID, it went as low as 2.875. So for an investment property to have an interest rate where you don't even have 20% equity, I mean, I've been waiting to refinance this property for a long time. We're almost getting there, kind of close. But it's been a great product because having that original fixed rate, it would have been 5.875 for the duration of the loan, which happens to be a 40-year amortization for another topic and another call.
All the interesting stuff.
Oh yeah, it's 103 LTV. Sure, why not?
Yeah, I have a very similar story with a client of mine, and I'd like to get your guys' opinion on this. So as interest rates go up, right? Well, let me save that question for the end. But I had a client back when you had more alternative documentation loans, big down payment, perfect credit score, lots of reserves, but she was self-employed and her income was variable. So we used something that was less. Didn't have to document her income, and I think it was a 10-year ARM. It was a 10/1 ARM, and she had this loan fixed for 10 years, or maybe it was 7 years, and then after the crash, it adjusted, and she was in panic mode, and she was like, "We've got to refinance this thing." And I'm, well, first of all, the product that we used to get you into the home doesn't exist anymore. But here's the good news. Your interest rate is going to go down every year for the foreseeable future. So it went just like yours, Paul. But I think it was closer to 6 or 7 back when we got the original loan. And it dropped like 2% every year for the next 3 or 4 years. So she never, and this was a jumbo loan too. This was a triplex in LA or something like that is what it was. And so here's my question, and I'd like to get your guys' opinion on this, is as we see fixed rate mortgages go up, are we also seeing those indexes go up now so that in the future, in maybe 5 or 7 years, what's the probability of those indexes going back down? So even if our loan does adjust, there's a probability of it adjusting down.
They're definitely trending up, but they're not super high. That's why the rates on these are actually lower. And like I said, on the one that I showed today, if you were hitting the end of your 7 years, you'd go from about 4.25 to about 3.85. So as long as rates are the same as they are today or lower, that product, which is pretty common jumbo loan product, would adjust lower. And it's a very common story. So it's funny, Paul, I was going to say, well, as you were telling that, I have the exact same story. In 2003, we did a 10-1 ARM at 4.375. And I said, why would I do anything else? There's no world in which I'm going to live in this home in 10 years. And what do you know? Here we are 19 years later. I'm still in the same house. And for us, it was fortunate. It wasn't COVID at that time, but it was the financial crisis, quantitative easing 1, 2, and 3. Every time that thing adjusted, we went from 4.375 to anywhere. I think the lowest it was like 2.59, and the highest it went was like 3.4. And I was actually mad the year that index, it was LIBOR, and LIBOR was up that year at our adjustment. It was the highest point in the year because we adjusted in October, and I was mad. I'm like, this is terrible. Why am I at 3.4%? And until COVID hit and rates went super low, we never swapped out of that loan because it stayed that low. So I don't know that I would necessarily count on it, Scott. None of us have a crystal ball, but you guys know my thoughts. I just shared them with you. I think that the trend for the near and midterm future is for rates to continue to go lower. When we get past the supply chain issues, when we get past the war issues, the only factor that's changed or that will permanently change post-COVID is we benefited from the tailwinds of globalization for the last 30, 40 years. And one of the outcomes of that was lower interest rates, lower costs for everything, but lower inflation. A disinflationary, not a deflationary, but a disinflationary environment led to lower prices and lower interest rates. Well, we kind of saw during COVID, and then definitely with the invasion of the Ukraine, the problems with these long global supply chains. So you're seeing nearshoring, friendshoring, pulling things. I mean, no one's going to go back to supply chains all within their own borders, but they're going to bring it closer. For the US, that means we're going to do more in Mexico, more in Canada, with allies that are close to us, and that may raise costs. We have technology in our favor, which is one of the big causes of disinflation over the long haul. So things like 3D printing, where things can be manufactured right, the parts can be manufactured right where things are put together, means that bringing those supply chains closer to home is not nearly as expensive as it once was. So it's an opportunity. But long way of saying that potential inflationary factor of not having the ability to globalize your workforce and your production would be the only thing that I could see coming out of COVID that would lead to a long-term trend towards higher interest rates. All of the things, the impacts of technology, the impacts of a graying population, not just in the United States, but worldwide, all of those things tell us that we are likely to have less inflation going forward. So it's funny. Let me transition from that to say two other things that work in your favor when you take a 5, 7, 10-year adjustable rate are related back to inflation, the good sides of inflation. So we're all well aware for the last year or two that inflation sucks, right? Last month we got CPI figure at 8.9%. No one wants to see that. But for homeowners that say, I had home price inflation of 20% last year, they all like that a lot. That sounds good, right? So if we go back 75, 76 years, that number nationwide in the United States has been about 4.5, 4.6%. So if we flash forward 10 years, in most 10-year windows, the last 75 years, your home is worth about 50% more. So you have a ton of equity in your home, which opens up some options if you're going to stay there. And most importantly, if your wage growth is 2%, 3%, you're making 25 to 30% more at the end of that 10-year time frame. So you make more, your home's worth more. Kind of going back to what Benson said, everything changes. Life is very different. One of the stories I love to tell, when I bought my first condo, I was living at home with my dad. So I never rented. I went from living at home free to buying a condo, and the payment was $1,138 a month. And about 2 days before we're ready to move in, after I had signed the loan docs, I'm in a full-blown panic. I'm like, how in God's name am I going to pay $1,138 every month? I've never made a rent check payment my entire life. And you laugh because you're like, that's stupid, Josh. We would all be thrilled to have an $1,138 monthly housing payment. And for most homeowners, after you make 3, 4, 5 payments, you go, oh, I was just being crazy. That all makes sense. And that's just sort of the impacts of inflation and your life changing in the ways that Benson was talking about. So long way of saying, I don't think adjustable rates are the answer for everyone. They're not even the answer for the majority of people, but it's something you probably want to talk to your loan officer about and see if it can be helpful for you in that process. So, we're going about 35 minutes here, but we can go as long as you guys want. But what are your thoughts? Any advice, any words of wisdom for potential buyers, borrowers, refinancers out there in the market now?
So,
go ahead.
Going into that wage, right? I talked to a lot of first-time home buyer, high wage earner, because we're in California, right? But then the downside is very expensive California homes. Over $1 million in Orange County for a condo that's 1,600 square foot. So you're going to be house poor for a couple of years. If you even with dual income, you're not going to have those crazy meals that you're always, every other weekend you're going out there. Whatever you're seeing on Facebook, you probably don't want to be doing that every week anymore, right? But I think that's temporary, right? Rate's going to come back down. You're going to have a chance to refinance. Your wage is going to continue to go up. You're going to reach high places, get the next promotion, get the next whatever it is, right? Your wage is going to continue to go up. So there isn't a whole lot of things to worry about. So if the payment works for you today, it works for you. No question about it.
The thing I wanted to interject here is really we talk about. I mean, if you've never done homework if you're a consumer, you've never done homework on an ARM, your head is spinning right now with 3 1s and 10 1s and 2 2 5s and indexes and margins. And the single most important thing is working with somebody like Paul, Josh, or Benson that can explain these things, because there are no surprises with an ARM loan. You know exactly what the index is. You know exactly what the margin is. You know exactly what the caps are and when they're going to happen. And you always have plenty of warning. And there's nothing ever locking you into that loan. If you've got a 7-1 ARM or a 10-1 ARM and 30-year interest rates in 6 years drop to below what your fixed rate is on your ARM, you refinance into that 30-year fixed loan, and then you don't even have to worry about it. But it's being educated and being informed and working with a professional and an expert that's going to treat you as though their family. I'm not going to let you get into any trouble here. I want you to understand exactly what's going on so that there are never any surprises. And that's the important thing. If somebody starts slinging arms at you and isn't breaking down the math and talking to you about exactly how they work, if all they're doing is leading with rate, you run like hell, right? Because there's, I mean, Josh, we know people in our space that are out there pushing 6-month ARMs because the interest rates are really low on Facebook ads. Right. And there are big companies that are doing that they're out there talking about mortgages in the under 3%. And those are very, very volatile products. And if you would never give that loan to your mom, right? You wouldn't let it happen. So it's important because ARMs can be very sexy if you just look at the interest rate and you don't look at the terms and don't understand the terms. What we're talking about here primarily are relatively safe, fixed for a long enough period of time that you're going to have options. You're going to have high probability of having options before that loan ever adjusts. And it's that balance between being conservative and having a little bit of a tolerance for risk, right? And
Yep.
all of that is supported by education and making sure that you understand and working with somebody that you might not remember in 3 years, but when Josh calls you 3 years later and says, hey, I've been watching the rates and I think there's an opportunity for you to fix that rate now, that's what a mortgage professional is going to do for you.
And I can give you a real life example of 4 years ago. Yeah. January of 2018, my wife and I settled on our new construction house and we did a jumbo 80-10. We did a piggyback financing 30, and we were looking at a 30-year fix for the first, but I went and looked at a 5-1 jumbo ARM. It ended up saving, instead of having a fixed rate of, I think it was at least 4.5, we were at 3.375 on a 5-1 jumbo ARM. And how I view ARMs, it's a micro bet. I look at myself and said, okay, we're going to save a full % on our major part of our loan because this is the loan we need to get. So there's a big jumbo lenders when you're pricing out subordinate financing with a second mortgage can get pretty expensive very fast. So fast forward to knowing, okay, we're going to save this amount per month over the next 5 years. Whenever there's an opportunity for me to get somewhere close to where this 5-1 ARM rate is, I'm going to take advantage of it. So when COVID hit, unfortunately, jumbo went away for a long time, the better part of a year. So early 2021, jumbo came back around. We were able to refinance into a 30-year fix at 3.25. So we actually went down an eighth of a rate and got a 30-year fix. So I'm not
eliminated the second probably because you had equity by then.
Fortunately, equity, we got a bump in equity. So we were able to be over 20% equity at the time when we did the refinance. It was like 25% equity. So good spot to be in.
And I think there's also one thing that we didn't touch on is, Paul, you kind of reminded everyone that, hey, you are saving money, right? Compared to a 30-year fix. And the money that you're saving, you can actually do a lot of things with it. If you were to find a certified financial planner or an advisor, you can definitely put that money into really, really good use. Stock market, whatever that is, you can get anything higher than what the rate is right now. You're going to make money, and in 7 years and 10 years, that money is going to snowball into a pretty big lump sum. And at that point, you can actually, if you want to pay down the mortgage, if you want to do anything with it, now you have the money to do that.
No, 100% agreed. Like the big theme, what you should take from this is they're a tool. There's a time and a place to use them. It's important to work with an expert and an advisor, both in the transaction, but it is not transactional, that is relational. And like Paul obviously managed his own mortgage through the years and through that process, but you want someone that's going to be doing that for you. So for our part, we screen all the folks that come into the Find My Way Home Expert Network, people like Benson, people like Paul, to make sure that they're transactional experts, but they're also relational experts, and they're watching their clients and taking care for your needs. They're not kids in the call center looking to do today's loan. They're looking to be your advisor for life. And especially when you're considering something important like a mortgage and an adjustable rate mortgage specifically, that can be really important. So thank both of you gentlemen, especially Paul. It's almost almost 9 p.m. It's past your bedtime in Philadelphia.
Paul, our idea of using natural light only worked for like the first 20 minutes of the podcast.
Really fizzled out on us, didn't it?
It only works for people that live on the best coast, Scott. The rest of you are in trouble.
Yeah. No,
all right,
really
guys.
Good conversation, guys. Thanks for unpacking that. That was that's a really relevant conversation. Yep.
Thanks for having me.
All right, join us
Good
next
to be
week.
here.
We'll go through another topic and bring you some more information, hopefully helpful in today's housing market. All right, thanks for joining us.